Welcome to The Pitch. I'm Ansley of Livewire Markets. And sometimes in financial markets, the best offense for a portfolio involves investing in defensive assets, like fixed income. So to find out what that means and where he is turning defense into offensive alpha, we are delighted to be joined by Tribeca Asia Credit Strategy Portfolio Manager, John Stover. John, very nice to see you. Fixed income is supposed to be an asset class for generating yield. It's finally generating yield after this humongous rate hiking cycle we've all been through. So just as a start, which corporates or sectors are you finding your most yield in at the moment?
Yeah, so I think if you look at what we do, we're about 50-50 investment grade and high yield. On the investment grade side, we really like the triple B space. I think the higher rated A space has gotten a little bit tight, but triple Bs are still close to the highest yield that you've seen over the past 10 to 15 years. And I think particularly when you think about we're at the cusp of the rate cutting cycle, you're obviously going to get a big benefit from that as those rate cuts come through. So we like actually around the region, to be honest. It's hard to pick out one particular sector or country, but we've had, around the region, financials, energy space, industrials in the triple B space, Southeast Asia, India, Australia, even a little bit in China and Hong Kong. And on the high yield side, we're really focused, there's still a lot of good value across both double Bs and single Bs. And, the sectors that I would call out that we like the best, Indian renewables, where we're still finding really good value relative to not just the green bonds that you would find elsewhere in the world, but just double Bs as a whole. So we're still finding good value there at 7 to 9% yield, and these are really stable businesses. Macau gaming, we actually quite like at the moment, and we've increased exposure there. This has really been, one of the sectors that has been a bright spot in China's COVID reopening, where a lot of other sectors have disappointed. You've seen mass gross gaming revenue actually higher than what you've seen at pre-COVID levels, and the valuations of the market just really haven't reflected that. And we do think that's going to get a big boost from the China consumer stimulus that you're seeing unveil at the moment. Indonesia is really another one that we like as well. We're finding value across the property space and natural resources there. That's really been kind of an overlooked market for a lot of people, not just globally, but even in the region. It's kind of been a stay away from them. But we have a lot of deep relationships with Indonesian corporates. And
Why has it been a stay away?
So there was some negative, credit issues in the 90s and 2000s, and I think that's just kind of a lot of people just say, okay, it's a stay away for us if we don't know which companies to get involved with. So I've been investing in the region, for 14 years. I've been based in Southeast Asia for 14 years, and did a lot of investing both directly, lending to companies there, as well as investing in liquid tradable bonds, which our portfolio is now comprised of only liquid bonds. So I know which companies and which families and business groups to get involved with and which not to. And we've had really strong returns from Indonesia over the past several years.
How do you mitigate risk and volatility in the Asian credit universe?
Yeah, we really focus on risk management and downside protection, not only as we think about which longs to put in our portfolio, but also we have a component of hedging, right? So we are a long short fund. And while we're long biased, we have a portfolio of shorts that we use to both express negative views on the companies, but also hedge the portfolio. So what we do is, on the hedging side, we look to have CDS, which are credit default swaps, where, we're actually buying protection against defaults. And then we also have a portfolio of tail risk hedging as well. So those all contribute to reducing the volatility in the portfolio. And if you look over the past 2 years, we've produced over 15% net returns in the portfolio with very low volatility. If you look at an experience like what we saw in August this year, for instance, where Japanese equity markets, Taiwan, Korea, they were each down the most in 30, 40, 50 years in one day. We were never down more than 0.7% month to date in August, and the same was true for the volatility in September. So I think that shows you how well the portfolio can hold up in times of really high stress in global markets.
You mentioned rate cuts a little bit earlier. If you don't mind a small follow-up without notice, with rate cuts starting to hit in the West, but particularly in the US, in a previous video, you actually alluded to the fact that we're starting to see rate cuts also filter through across Southeast Asia, which is where you're based. Does that bias you a little bit towards more that high yield market? Do you start to nibble away at a little more risk as those rate cuts come in, or not necessarily?
Well, I think we're going to still stay balanced between investment grade and high yield. I mean, if you look at it, actually rate cuts benefit the investment grade market the most. Those are most sensitive to interest rates on the bond trading side. Now, of course, if you look at corporate cash flows and earnings trajectory, your high yield is actually going to be more sensitive to that. So I think first we benefit from our portfolio on the investment grade side. We may look to get more high yield if you go over the next 6 to 12 months. But I think the target going forward is likely to be still balanced sort of around investment grade and high yield, because we are still a little bit concerned about U.S. recession risk next year. And while I think the Asia is much better set up this time to withstand those impacts, because Asia, most of what we're exposed to has a good domestic demand story, like Indonesia and India. It's really not as exposed to what's happening in the U.S. like some of the export economies like Korea and Taiwan, where we don't have much exposure. But we still, a little bit cautious, just if we do see a U.S. recession next year.
Okay, so all that said, what kinds of returns have you been generating with this process, and how often do investors see those returns?
Yeah, we've done over 15% net for the past 2 financial years in Australia, and that's been a combination of both income and capital appreciation. So there are both of those components in our strategy. So we've actually distributed between 6 to 7% annually in the portfolio, and then obviously there's been another component of capital appreciation as well. So you've seen sort of roughly 50-50 split since inception between capital appreciation and income. And we expect that to be roughly the same going forward.
All right, John Stover of Tribeca, thank you very much for joining us. Good to have you out here from Singapore as well. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website as well as our YouTube channel. And we'll see you again for more episodes of The Pitch next time. Take care.